The US Federal Reserve met for the first time this year and pushed back on any imminent rate cuts, sending Wall Street lower. In this video, we'll discuss what came from that first Fed meeting of 2024, what the implications are for US indices, and of course, analyze the charts of the Nasdaq and S&P 500. But before we do any of that, remember to like, subscribe, and comment on this video as well. We'll be sure to get back to you. Give us your view on what you think the Fed will do with policy in 2024. So let's kick things off by going into Rewind very briefly. And as many would be well aware, we've seen record highs recently on Wall Street, really driven by expectations that the US Federal Reserve will be cutting interest rates fairly soon and deeply in 2024. Now, a part of that was stoked by the Fed last year when in its last meeting, it updated its statement of economic projections and suggested that as many as 3 cuts were in the pipeline for this year. And Fed Chair Jerome Powell indicated in his press conference that the conditions for rate cuts were discussed at that particular meeting. So that set off a flurry of activity and excitement amongst market participants that the rate hiking cycle from the Fed is not only finished, but that we could be beginning a rate cutting cycle, which is, of course, great for financial multiples in the stock market. Now, over the last few weeks, there had been some pushback from Fed speakers suggesting that maybe the Fed made a little bit of an error in preempting policy easing. And, well, we're concerned that perhaps that easing in the market was manifesting in looser financial conditions, which could stoke again inflation, or if nothing else, make it more difficult for inflation to come back down to target. Well, certainly judging by the tone of the Fed Chair Jerome Powell at his press conference after the Fed decided to keep policy unchanged at this meeting, it certainly seemed to reflect some regret, perhaps, or at least an attempt to wind back some of the cuts priced in to the market, especially for March. The key moment came in the press conference from Jay Powell when questioned on whether a March cut was on the cards. He suggested more or less that it was unlikely, sending the Nasdaq lower in particular, that tech-sensitive sector, but as well as the broader S&P 500. So it raises really the question now as to whether the markets have mispriced the situation, that this run-up to record highs that we have seen from Wall Street is based on the very false assumption that rates will be cut this year in response to lower inflation pressures. And, well, even on top of just the rhetoric from the Fed, some of the economic data recently is backing that up as well. Very resilient growth in terms of GDP, a very resilient consumer spending, and a labour market that still remains relatively tight and an unemployment rate near record lows. So there's a renewed volatility and uncertainty in the market. And again, this is manifesting in lower equity prices. Let's have a look at some charts that illustrate this story very well. We'll start with the Fed Fund Futures Curve, which gives a little bit of an impression as to where rate expectations have gone over the last couple of weeks in particular. I've compared here the curve from the middle of January to today, the start of February, after the latest Fed meeting. You can see that it has steepened significantly, and we have seen a fairly meaningful pricing out of both the number of cuts this year as well as the timing of when those cuts will occur. Now, the effect of that is once more lower multiples for equities as well. Bonds and other assets tied to interest rates, safer assets, become a little bit more appealing by virtue of those slightly higher yields because of these higher interest rate expectations. So that dynamic has really slowed the upside momentum for Wall Street equities, despite the fact that we have seen record highs eked out at different stages over the last few weeks. What is a curious dynamic following the Fed meeting in the last day or so, however, is although the timing of the first cut has been changed materially, the number of rate cuts expected for this year hasn't changed by the same magnitude. Now, what do I mean by that? Well, to illustrate, the odds of a cut in March has fallen to around 30 to 35% based on Fed Fund futures. But in fact, there was an increase in the odds off the back of just this Fed meeting of 5 rate cuts this year from the Fed, which is essentially to say that the longer that the Fed waits to lower interest rates, the more aggressive the market thinks they'll have to be eventually in bringing them down. Perhaps a reflection that the market thinks current policy settings are overly restrictive and that maybe there's something of a meaningful slowdown coming in the US economy that will require, again, somewhere between 5 to 6 interest rate cuts in the year ahead. The chart you can see on your screen here is the spread between the March futures contract and the December futures contract. A higher number suggests a greater number of cuts between that period. And again, that lower implied probability of cuts in March just says that there will be the same cuts, but they'll just happen quicker. And probably, at least when you look at the futures markets now and what they're implying, around May and then subsequent to that as well, 5, maybe 6 cuts in the year ahead. Now, the final chart deviates a little bit from the Fed in particular, but it does talk about one thing that is also weighing on equity prices in the moment, and this is disappointing earnings, especially out of some of the tech giants recently, but just broadly across the board. There were very lofty expectations for the market and the S&P 500 when it came to earnings, not just, this quarter, there was expected to be slightly positive earnings growth, but throughout the calendar year 2024, 10, 11% earnings growth if you look at FactSet data. Now, what we've got here is how earnings expectations have changed, not just for the fourth quarter, the earnings season that we're currently finding ourselves in, but also a quarter ahead from now. And you can see, compared to the start of the reporting period, or here, it's 31st of December that FactSet uses, we've seen the Q4 earnings per share estimate go into negative territory. We'll call it around 1.4%, as you can see there. And the earnings estimate for Q1 revised down from 6% to 4.6%. So not only do we have policy settings becoming less accommodative for stocks, so multiples falling again as interest rate cuts are unwound, but also that the lofty expectations for earnings growth in the year ahead are being revised lower and perhaps consistent with the economic slowdown that is still being reflected in interest rate markets. Let's run through a look at the technicals now, and you can see that the Nasdaq remains in a primary uptrend marked by higher highs and lower lows. However, momentum is going in reverse, as you can see on the daily RSI there, and we've approached a fairly key level for the Nasdaq around the 20-day moving average, as well as what you could say is a tentative level of short-term technical support. Now, if that breaks down, it really does bring 17,000 into view once again, which could see some buying support come into the market really on the basis that it was a previous level of technical resistance. But if it breaks through there, there really could be some free air to go. And that's a major risk if we continue to see disappointing tech earnings, as well as this unwinding of expectations of a Fed cut in March. On the flip side, however, clearly seeing sellers come through at around 17,600, which if we push above that level would be a very bullish signal, would equate to a continuation of the uptrend. Again, on the flip side of that, we probably need to see more resilient tech earnings, as well as a repricing of higher probabilities of interest rate cuts from the Fed in March. Also now a look here too at the S&P 500. A similar story, was in overbought territory, has since pulled back from that level of momentum skewed to the downside, still in a primary uptrend, with only making record highs a couple of nights ago. So still a very bullish market, and from a structural standpoint, the trend skewed to the upside. But we're also receding to that 20-day moving average, which also coincides with a significant level of technical support around previous all-time highs. You could also argue that there's a confluence of support there with a 20-day moving average and those previous all-time highs around 48.30. We break through there. There is a level of short-term trend line support. You can see prices in that sort of short-term trend channel at the moment, which could attract some buyers not far off that 50-day moving average at around 47.50. Meanwhile, same story as the Nasdaq. If we break to new highs, a clearly bullish signal will require that headwinds of earnings downgrades, as well as the pricing out of interest rate cuts, to become tailwinds once again by virtue of, again, that perception of resilient earnings as well as rate cuts to come in March. Fed meeting of the year brought with it a level of volatility not seen in just a little while. So the question does remain, when the Fed cuts and how quickly does it cut? The direction for equities really does depend on it.